let's get to it, shall we? So the one daily trade every profile trader should have. So if you joined us before for any of these Thursday sessions, now I typically have stayed fairly high level and rather conceptual. I want to dig down into some more practical applications today. Not that I don't think any of the other ones we've done have not been practical, but sometimes you need a foundation of understanding before you can kind of dig in, or you lose the context. And this is one of those that if there's some concepts you don't quite understand around auction theory, it's going to be tough. But hopefully we can show enough practical examples. You can come back and review this and find some value. So let's dig in. This is me, and people ask, who's the Market Profile Trading Academy? One is me. I'm Josh Schuler. I'm one of our mentors. I'm also a Series 3 broker through R.J. O'Brien, which is one of the oldest commodity brokerages in the country, over 100 years old. And I'm reaching you guys today from Fort Collins, Colorado, beautiful northern Colorado, Fort Collins. And the other part of our team is Matt Davio. Matt actually was my mentor in market. So when I was screwing around trying to figure out how to do this game, I got connected to Matt through another friend, and he really peeled the scales out from my eyes on what was going on in markets, and he really helped me get to a place that, well, I mean, Matt and I hope to get every trader to, and that is a place of independent competence. And what we mean by independent competence is that you can approach the market every day and choose your spots. Pick when you want to trade, know what works for you, what doesn't work for you, and do that over and over and over again. I actually started out trading, and I was very successful early on because I followed somebody else, and I just happened to find someone to follow who was legit. Unfortunately, there's lots of people that spend money on systems and following people, and it's not legit, and that's an unfortunate circumstance. I was fortunate in that I found someone who could actually trade, but I found that on days when she was not around, I struggled, and if I tried to fly on my own, I got bit. So I was really after, for myself, some independent competence, and looked initially at Market Profile as a way to do that. Explain why here in a little bit. And got connected to Matt, who really helped me take the concept into something applicable. So we're going to do that actually today. If you've been around for some of these, we typically start with an idea. And this is one that if you've been to any of these before, you'll hear it. So forgive me if I'm being like a broken record, but I still think this is relevant, is that businesses excel when they're ahead of the curve, when they see the opportunity before it is realized. This is why the person in the network marketing scheme makes money on the front end. It's not the person on the back end. And another classic example, my wife and I were driving around town this weekend, and we saw somebody was opening one of these escape rooms, which I'm familiar with these. It's a fun family or a friend thing where you go and you get basically locked into a room with a bunch of other people, and you're given all these clues, and somewhere in the room is the key to get out, but you have to solve clues together. It's kind of a collaborative effort. Really fun, really cool. They're popping up all over the place, but they've been around for a little while, a couple years, and the more that pop up, you kind of have to wonder, how long does this business have to go? I mean, how long is this going to be around? It's kind of faddish. I think it's going to die. The person who made money with the concept was the first person who came up with the concept, not the person who could identify the trend and try to jump on that train. Same thing, that's true in business, is true in markets, and we hammer this over and over and over again, is that the opportunity is found when you can see an opportunity before it happens, not after it's already developed. Matt and I believe it or not, we talk to hedge fund managers all the time that are trend-following hedge funds, and their performance is bad because, especially this year, for example, where you're in a non-trending market in a lot of these products, if you're a trend-following, what's the trend? How do you do that? You're getting jostled around. So just about the time you think that you're getting into a trend, it turns the other way, and they're taking losses. So this is a key concept. Another one is that, when we, as a trading academy, so we're coming alongside traders to support them to independent competence. And one of the driving principles around that is helping them lean on probabilities of what is likely to happen or occur, making contingencies for what could happen. So like if you're playing poker, there's certain hands that if I have this hand, there's a probability that increases my likelihood of winning. And so, if I'm playing, I can't see everybody else's cards, then, I'm looking for that hand and I'm going to bet based on the probability of what's likely to occur based on what in my hand and everyone else. Now, it doesn't mean that somebody else couldn't have that trump hand that, that takes me out, and I can make a contingency for that in the way that I bet, but it does mean that I can have some probabilities around it. Same thing in markets. The cool thing is that in markets, I can see everybody's cards. So it's not just knowing probabilities, but it's also I can see all the players. So this should be key, and it's something that we drive home a lot. And it's also relevant today when we talk about this one trade idea every profile trader needs. Last concept is that, for years of working with traders and coming alongside them, here are consistent challenges that we find, and maybe you can resonate with these. One is on a given day that you're going to place a trade, discerning bias. And what I mean by bias is who's in control on that day directionally. Is it a bullish or bearish day? So was the trade long or was the trade short? Really easy to identify in hindsight, hard to identify on the hard right edge. And I'm hoping today helps you drastically with that. Second is knowing when you're wrong. Working with a couple guys right now who actually have a higher than 70% win rate, and yet they are drawing down on their accounts. So how is it possible that 7 out of 10 trades or better, they're right, and yet they draw down their accounts? It's because the 30% when they're wrong, they don't know how to cut the trades, or they don't know, when they're wrong, or they can't establish that, and so those trades become losers that take out the wins. So knowing where you're wrong so that you can take the appropriate activity, very, very, very powerful and very helpful for traders. If you could just knock out these two things, trading performance would drastically improve. Okay, so if you by chance have a piece of paper in front of you and a notepad, I have two questions for you, and this just for you personally. You don't need to share this with anybody, but just think about these as we go forward. So one is, when you trade, are you looking for price action or are you looking for behavior? Are you looking for price action or are you looking for behavior? I'll give you some time to write that down. Wish I could pipe in some Jeopardy music or something. So when you trade, are you looking for price action or behavior? And you may, and it's totally okay if you're like, behavior, what does that mean? Or price action, what does that mean? We'll talk about that. Price action would mean that I'm looking for, in definition, some type of momentum or a degree of movement in price action, a volume behind it, for example. Or a behavior could be that, it could also be a momentum. It could be in relation to some prior activity. It could also be in the type of day that takes place that tells you something about the participants that are there. So when you trade, are you looking for price action or behavior? Second question, there's only two today. I'm not like I have a litany of these. But think about how your life would be different if you had one anchor approach you could use every day. So not how your trading would be different. How would your life be different if you knew, hey, every time I sit down to trade, I have one trade idea I can use every day? I'm hoping that when you think about that, you're like, oh man, that would be awesome to have something that's an ace in the hole. I hope that's the case, because that's what I want to give you today is one trade idea. So let's dive into this, shall we? We're done with the prelude. Now let's get into this, and let me show you some examples and then see what kind of questions or ideas pop up. Okay, this is results from my trades today. These are live trades. I did a long trade in crude oil. You can see 3 contracts in and out, and 1 contract in and out of NASDAQ. Between the 2 trades, $755 in live money. If you annualize that, it's over 252 trading sessions. That's not a bad way to live. This was kind of a so-so day for me, but I think this this at least shows you I employed this idea today, and I was going to show you if it had just happened these worked out, but even if they hadn't, but this was results from today using this trade idea. So what is this trade idea that I'm using every single day? Well, here it is. Identifying range extension in trading products provides an actionable trade idea for any product, especially futures, every single session. Identifying range extension in trading products provides an actionable trade idea for any product, especially futures, every single session. Now, what do you need to be able to leverage this, and what exactly does it mean, range extension in a trading product? Well, here are the components that you need in this idea. One is that you need to know the initial balance. So when we say range extension, we're talking about price that extends beyond the range of the first hour of trade. Pick a product, stock, future, doesn't matter. But what's the high after the first hour? What's the low after the first hour? Mark them. Okay. In auction theory, we look at sessions based on 30 minutes. And we call them periods. So A period to B period. What's the high? What's the low? Let's mark those. That's what we call the initial balance in the first hour of trade. Actually, if you look at CME data that's coming out, 80% of trade that happens outside of that first hour is all computers. So when you talk about active people placing trades, they're typically placing them in that first hour. We can still trade the rest of the time, but just know who you're playing with. Okay, so that's the first voucher. That's one of the components you have to know. Second, you have to track the average initial balance width. Now, I use a rolling 20-day period in tracking the IB width, but if you want to know why 20 days and not 30 days or 50 days, just send me an email at some point and we'll walk through that. But an average IB width, you need to know what this is. Thirdly, you need to understand day types in auction theory. And when we mean auction theory, it's based on the research of Peter Stottlemyre at the Chicago Board of Trade in the 80s, who was looking at consistent behaviors inside the auction and discerning behavior. So this goes back to are you looking for price or behavior that was happening every day? And there are consistent day types that occur every day, and they can be marked. And if you understand those, along with the average IB width, initial balance, this is a component in this trade idea. Third, you have to be able to conceptualize rotation. So this is being able to think through what the day could look like as it plays out before it's played out. And this takes some time to acquire, but once you have enough samples and experience, you can do this where you can go, oh yeah, it's gonna start looking like this. And specifically, this is more easily seen using the market profile graphic. And the market profile graphic is a way to visualize this auction taking place upon which the auction theory is based. Okay, next, you need to know the average trading range of a product. So believe it or not, trading products, each product, they're almost like people. They have different behaviors, but they have a rolling average trading range of how wide they're going to be on a given day. Now again, it's an average, so that means we can be less than that, we can be wider than that, and they will change throughout the year. But tracking average trading range can give you very, very powerful information in using this trading idea. Another component, VWAP. So this is the volume weighted average price computed during a day session on the product that you're trading. I will tell you that if this is not in your suite of tools that you use, please consider adding it as an indicator. The reason for that is it's showing a statistical weighted mean based on volume throughout the day, and guess what? People are writing algorithms based on movement away from this volume weighted average price. So the further we get away from this price, the more likely they are to trigger computers to go back the other way and to write sell programs or buy programs. So knowing where that is helpful in this trade setup. And the last component that you need is the VPOC, or the volume point of control. What the volume point of the control is on a given day, it is the price where we have done the most volume at a price. So if you've ever seen a time-based chart where it's showing a candle and it's at certain minute increments or daily increments, and it shows the volume, that's how much volume was traded in that time period. It doesn't show how much volume was traded at each price. And if you've ever been around an auction or observed auction behavior, auction type behavior, you know that volume at a price is important. Probably the one that most all of us know are like housing markets. Whenever I go to sell a house, what's one of the things that they ask me to do if I'm going to get a loan or if I'm going to price my house? It's based on what are the comps. So what are the prices of the houses around me selling for? That tells me the volume. If there's being able to be transactions taking at that price, that's volume at a price. And then if all of a sudden some price trades way higher, well then that is new information in the market, but it may not be relevant because it's just price when the volume at price is much lower. So unless I see lots of houses changing or hands and transacting higher, then price is likely to return back to value. Now, the other thing that can happen is that price moves and I get more transactions, and then the volume moves toward price. So that also occurs. It's a behavior to look for. But here are the components in this trade idea. And let's dig down a little bit deeper into the statistics around this. So I did a study of 1,000 trading sessions, and on 1,000 trading sessions, there is a 95% probability that price extends beyond the initial balance. So we talked about the initial balance being that first hour of trade from the top of the IB to the bottom of the IB. Mark what those are. There's a 95% probability that price extends beyond that. Okay, it's a very high probability over 1,000 trading sessions. Second component of the study is that over 1,000 trading sessions, there's a 68% probability that price extends beyond the initial balance in only one direction. So if I have a high or a low, 68 to 70% of the time, it's only going to trade through one of them. So that means that the other one is an extreme that will not be violated the rest of the trading session. 68 to 70% of the time. Okay, this is very statistically important, because if you've done any studies of statistics, you'll know that 68%. If you've done statistic studies, all of a sudden you go, oh, that's a normal distribution. Yeah, in studies of probabilities, that's saying most all observable examples will fall within this range. So that says that most days I approach the market in a product that I'm looking at, if I know what the IB is, there's a 95% it's going to extend in one direction or the other, and 68% of the time it's only going to extend one of those. Okay. Here's the third component, is that 68% of all trading sessions then present what we call a normal day type. When we look at the live examples, I'll talk about what a normal day type looks like. But just so that you know that I'm not pulling this out of my rear, here are the actual stats on 3 different products, futures products. I actually checked this against Apple stock as well. Same thing. You can see on all of these products that I'm looking at somewhere around 1,000 samples, and in this I'm showing this is how many times do we break out of the IB high. This is 352 out of 1,000, so 35.2% on U.S. Treasury bonds. How many times do we break to the low side? This is 31.5% to the low side, out of 315 out of 1,000. How do we 30% we break out of both? You'll notice that these statistics are very similar on all of these products. We have oil here, we have ES on the right. 3 very popular futures products, for example, that are traded, and the statistics hold on all of these. Now, there is some, a probability that they can extend through both, okay? And there are rare instances when it doesn't extend through either, but most often it's going to extend from one to the other. So now, what does this mean? So let's look at this practically. So I'm going to look here. This is a market profile chart. In case you wonder, I'm using WindowTrader Blue, fantastic profiling software. And here is today in crude oil. So I wanted to trade crude oil, and as I was trading crude oil today, this green line right here that you see is the initial balance. So that's the first hour of trade. You will notice that we extended where in that? Did we extend both sides? No, we did not. We extended one side of the range. Which side do we extend to? We extended the upside. Here's what you should know when you see range extension. Okay? When you see range extension, you are seeing the behavior of participants who don't care what the price is yesterday. So they are what we call in auction theory other time frame participants. And they are essentially, they're the guy who's willing to buy above value. So this blue bar, for example, or this area represented value yesterday in crude oil. This is the overnight session, and then here's the real-time session. So this is a group that was willing to buy above value. So here's the first half hour. This is breaking out in 30 minutes sessions here. Here's the first half hour. Here's the first hour. There's your IB. Okay. C period inside the IB. D period, we break out. So if it's an other time frame participant, is this an other time frame buyer or is this an other time frame seller? Well, it's an other time frame buyer. So here's what I'm thinking as an oil trader. I'm thinking, okay, buyers are present. I know 70% chance we're only going to extend the range in one direction. I have now likely defined the extreme low for the day, which would be what? It would be the low of the IB. So it was 49.24. So once I saw us break out, then I started saying, okay, here's what I want to do. Any pullbacks that I get in oil, I am going to buy. I'm going to start buying. And I'm expecting there to be, rotations higher in oil. Now, how high? This is why one of those components was the average trading range. So right now, the average trading range for a session of oil is about $1.23. Okay, so that's the full session. So if I look down here at $49 and I add $1.23 to that, that gets me to $50.23. So when I saw range extension happen here at $49.77, I had potentially 50 cents of range that was possible on the day. 50 cents in one crude oil contract is $500. Okay. So when I got this pullback in this period right here in E period, I bought. In fact, I bought at 66. And now, here's the thing. I was willing to buy all the way back to 24. So I was, bought one. You can see, from the stuff that I showed you, I bought one, but I was prepared to go all the way back to 26. Why was I prepared to go all the way back to 26? Is because I'm thinking that's going to be the extreme of the day, and I could get my average such, knowing that I got all this headroom up above me, I'd have good trade location to have a likely probability of booking this trade at profit. So I'm not smart. I don't load the cannon here on the first pullback. I nibble. But in futures, you don't have to go crazy big to make decent money, right? So you can buy one. I was willing to buy two more down here at the bottom. So I'd have 3 total. Now, check this out. Remember when I said that one of the challenges that we see of traders is they don't know where they're wrong? So my hypothesis on this trade is that we're only going to extend the range in one direction. So what would say that my hypothesis was wrong? Is if we extend it in the other direction. Okay. In fact, this actually happened not today, but yesterday. If I break out and expand this profile, oh no, wait, that wasn't yesterday, it was the day prior. day prior. Look at this profile here. On Wednesday we had, I'm sorry, this was on Tuesday. Notice here's the IB. We extend higher, okay? On the pullback, I was buying into this. I think my first buy was at 50.40. My second buy was at 50.10, and then we broke. Guess what I did as soon as we broke? I knew I was wrong, and I covered my position. So, and I'm glad that I did, because we had what was called a normal variation. Well, I mean, it's normal variation or a neutral extreme day. A neutral day is a day type in auction theories where you extend both to the upside and the downside. We close at the end. That's a neutral extreme day. It could also be a normal variation day type where you have rotations in one direction and then a spike and then rotations in the other, and you have as wide a profile above of the IB as below. But what was so powerful is I knew where I was wrong, so that gave me confidence to be into the position and then know when to take it off and save myself from loss. Today, the trade works. And here's the thing. According to statistics, if I get enough samples, it's going to work around 70% of the time. So that means that if I cut my losses when I know that I'm wrong and I pull this trade 70% of the time, guess what's going to happen to my account? I'm going to make money. And if you're in trading, although, I mean, I think if you're going to be successful in trading, you have to really just love the game. But we can't stay in trading if we don't make money. And what I'm trying to share with you here is a trading idea that you can use every single day on any product that is actionable and can give you a high probability of success. Here's another one. This is the NASDAQ. Okay, so today in the NASDAQ, we had a very wide IB. So, remember one of the other stats that I give was, you need to know the average IB width. And why? Because one of the day types, if it's in a normal day type, we talked about normal day type. A normal day type is where we have a wider initial balance relative to the average, and it contains most of the day's trade. So we may get range extension. We're likely to get range extension, but in that case, it doesn't extend it very, very much. So early in the day, I saw we had this wide initial balance, and the reason I know this is wide is because look at this. If we go in here and we look at the statistics, okay, look, here is the IB. This is 129 ticks today. The average IB width is 87 ticks. So we were more than 2 standard deviations above the average IB. So probabilistically, statistically, it was a good bet that we were going to stay inside of this range. So then I bought 50 right here. I was willing to add down to 30, okay? Right down here, there was a high volume node. We'd cover that in another webinar, but I was willing to buy that. The other reason I was willing to buy down to 30 is because the average range of the day is 153 ticks. Now you can see we exceeded that almost by double today. So this is stuff can happen. This is why we have room for contingencies. But when I bought in at 50, I was looking for it to rotate back in as the day was trading. Now this is where that VWAP is very important. Okay, so at the point at which I entered at 50, the volume weighted average price was 57. Okay, look where we turned around on the day, and that's where I set my sell order, was at 57, and look where we turned around. Do you think that's a coincidence? It's not a coincidence. So when I got into this trade, one, I had good trade location as of the day because I had from 80 down to 50. I had 30 points above me. The average trading range in NASDAQ up till today is around 45 points. So, I got 15 points of breathing room, before I then start thinking about it and changing my perspective and thinking this is one of those days that, don't follow the statistics. So I had a, good strategy for where I was going to get in, traded back to the VWAP, took the trade off, and I was done. 2 trades between crude and NASDAQ using this idea. I can use this every day. I'll use it tomorrow. I used it yesterday. I used it the day before, and I hope that you can use it as well. So to that end, let's go back to our slides here. Look at some examples. Be thinking about some Q&A. If you have any questions or we want to look at some other examples, we can. But I got some homework for you. One of those is to pick one product, and you're going to pick this one product, and then you're going to observe the IB establishment every day. Look at that IB. Where's the high? Where's low? And again, the IB is the first hour of trade that takes place, and then you're going to watch for range extension. Okay, and one, if you know the average range of the IB, you will know, hey, is this a smaller IB? Is this a wider IB? If you have an IB, for example, if the IB is 20 points, I mean, for example, let's look at the Nasdaq. If the average IB of the Nasdaq current average is 87 ticks, okay, so Nasdaq moves in 4 ticks, so 87 divided by 4, so we're looking at 21 points is the average IB. And if you know that that's the average, and say we finish the first hour and we're trading at 10 points, then you can almost put a buy stop or a sell stop above the high and go in that direction, knowing that not only do you have a narrow IB, so think of an IB like a teacup, and the smaller that cup is, but you're pouring the same amount of water in it, how likely is it to spill over? Again, this is all based on probabilities, what is likely, not what could happen, right? So the tighter that is, the greater confidence you can have is that if we break out of that, I'm going to go with it. Now, if it's a really wide IB, in that sense, then you're going to say, oh, well then, if we get range extension, that allows me an opportunity to go back the other direction because we're likely to contain that. So watch that IB, know the average IB width. You can do this in Excel on the spreadsheet. You can just mark, go back about 20 days, figure out what the average IB width is for that one product, and then watch that behavior. So that is enter and manage trades to profit or loss. If you see IB extension, go in the direction of the extension, but don't use all your bullets. I mean, leave some on the table to use that extreme on the other side as something to lean against. And then if you break that, take the trade off. Do this 100 times and see if it does not drastically improve the performance of your trading. So that is it. That is my one trade idea that I think every profile trader should have. I actually think every trader should have. You can use that. You can pick the product that you want to use. If you want to trade stocks with it, trade stocks with it. Like I said, I've checked the stats on stocks or futures. It works the same way. Around 68, 70% of the time, we're going to extend the range in only one direction. So look on that, lean on that, and have some fun. Send me your examples or what product you're looking at. I think that could be a really fun thing to look at. So that is it. Anybody got any questions? Let's cover them. Otherwise, we'll wrap up and get done. I know Jed has one question, is whether that beard is for winter, and I said, absolutely. This is my ski beard, and all I got to say is beard oil, my friend. Colorado Beard Company. You got to put some oil in that hedge, or you can't get to that stage. So I'm preparing for ski season. I got the passes ready to rock and roll. While anybody's thinking about any other questions, something to let you know about, next week we have another session of our quick launch workshop. We have registration open through Sunday night, I believe. It's not cheap. It's $788 for a session, but you can see that the idea that I just gave you, I paid for it in one day. So I think it's worth the investment. We're going to look specifically in this session of the workshop. We have 3 sessions. 2 of them we did earlier this quarter. This one is around finding market opportunities that fit your unique trading goals. So we'll cover this specific trading idea and opportunity, but this is just a basic one. There are many others that we use outside of even just the day time frame. So if you want to do more multi-day swings and such, you have to use a little bit different approach, but somewhat based on the same fundamental idea. But I wanted to get this idea out here because I think it could really help people as they're trying to discern bias on a given day and also trying to know where are you wrong. This trade idea, absolutely can know that. Absolutely know that. So please use that to your benefit, and if it works for you, man, just shoot us an email, come to our website, shoot, on the contact form, and let us know that it was helpful for you. I would love to hear that it was helping you each day, figuring out, man, should I be long? Should I be short? Did I need to cut that trade? Did I need to let it go? Because those are the consistent things I deal with every day when someone's struggling on performance. So check that out, and we'll talk about the other thing. Yeah, Q&A. Any other questions? Yeah. That's not so much a question, but a comment, and this is true, that this idea has been a producer for many years. Notice I did 1,000 days or sessions. That's almost 5 years of data that this is true. So pay attention, pay heed. There are lots of trade ideas that only work in certain market cycles. This works all the time. This is, this idea, if you need some time and want to, you can go find this book. This was the CBOT's Market Profile Guide. It's a 6-part study guide that was published in 1987. If you care to read it, be my guest. It's thick. That's printed both sides, by the way. It's hard to read because if you're not seeing this every day, some of the concepts seem abstract. That's why I actually started working with Matt, because I needed to be able to see it in real time. That's why we offer this webinar, why we do our workshops, because you can see these concepts happening in real time. But yeah, this works over and over and over again. It is a really great trade setup. So please use it, and regale me with stories about how it helps you every day. That would be fantastic. Yeah. If it didn't work, then we'd have hundreds of inside days in one straight sideways market. Yeah, that's true. This works. It really, really works. It's the real deal, guys. It's the real deal. Questions? Comments? Complaints? We can come back here. We can even look at some other examples. I think it's always fun just to go back and look at days and see, how many days it only extended in one direction. I'm always amazed, and I'm also amazed when I see how wide the IB is. If it's a narrower IB, how much range extension there is. So you can actually, get the other side of that range extension and have a great idea. This is Treasury bonds, by the way. ES. And again, we looked at this on every product. I looked at bonds. I looked at agriculture stuff. I looked at energy stocks or energy futures. I looked at stocks. It doesn't matter the product. This stuff works. Now, one thing to bear in mind, the reason I said 100 samples is because I can flip a coin, and this is the way probabilities work. I can flip a coin 10 times, and 7 out of those times hit heads, or even 9 times hit heads, and I'm like, oh, well, I can hit heads all the time. But this is if I flip coins enough, if I get 1,000 samples, it's going to even out to be 50-50. It's going to work according to the probabilities. So, you may find a string of neutral days, for example. Neutral days where we extend both. That's one of those days where we extend in both directions, the 20% of the time. Okay, you may find a string of those because we could have had news-related markets. Typically, neutral day shows up when we have news-related binary type information coming into the market, but that's okay. If it's valid enough and you can lean against it, it will work for you for all the times that it doesn't. And again, if you keep your risks tight and controlled on those, and you cut your losses when it's not working, then you'll be fine and it'll work. One last thing that I will I will say, and then get out of here, is hey, if you want me to look a little bit deeper into, I mean, I really would love to help you in your trading. We don't sell a system, we sell competence, and it's going to be unique for every trader. We do have a Slack team that we're trying to have conversations around this approach every day. It's free. Just contact us through our website, and we'll get you an invite in there. Also, just use this link if you'd like to set up a free consult, calendly.com/MPTA. You can pick a time if it's available, so it syncs to my schedule, and I have so many of those I allow a day, and I'm happy to talk to traders because I know this stuff is hard, and sometimes you just need someone to hear you. and if I can give you a concrete idea to help you move forward in that half hour, I'm happy to do that, because I think markets will be better if they're more competent participants. And I see it on the brokerage side all the time where people are just making trades based on emotion and not on a plan, and the ones who trade on emotion don't last. The ones who have very good plan and they know what they're doing, they last, and they win big in this business. And I want you to win big. All right. Well, I don't see any other questions coming through, so we will cut out of here early, and I will see you all later. Got the workshop next week. Again, go to our website, marketprofiletradingacademy.com/workshop. You can register for the session there. You can either register for just that one or all 3 sessions. There are 3 sessions. It's a total deal. And you can also find the information about the free consults as well. Thanks for sticking around, everybody. I hope that this is a valuable lesson for you that you can use starting tomorrow, and that it encourages you and it gives you some confidence to go forward in this game. So trade well, and we'll see you next time.